Welcome to the Real News Network. I'm Paul Jay, and we're coming to you today from the Perry Institute in Amherst, Massachusetts. And now joining us to talk about the $600 billion Fed move and what does it mean to the economy and to all of us is Yves Smith. Yves is the creator of the influential financial blog Naked Capitalism, author of Econ, How Unenlightened Self-Interest Undermined Democracy and Corrupted Capitalism. Thanks for joining us.
Thanks so much. My pleasure to be here.
So let's see if I have this right. The Fed's going to take $600 billion and buy government bonds that are owned by the big banks, except they're not just going to buy them from the banks, they're going to let other people buy them from the banks and then sell them to the Fed and make money on that. I mean, the whole thing seems rather bizarre. The critics are saying that this move, as many other moves of the Fed, seem to have absolute benefit for the big banks and relative to dubious benefit to the economy. So what's your take?
I would agree with that. So what we've had, the Fed has been engaged in two efforts, only one of which has been somewhat successful. They've been trying on the QT to shore up the balance sheets of the banks. They had explicit programs during the crisis. You remember they had an alphabet soup of different rescue programs. And their second effort has been to have very low interest rates in the hopes that bank would go out and lend in order to stimulate the economy, but also just to make a big spread between the low lending costs, the low borrowing costs, and what they're lending it on.
They're getting money at zero.
They're getting money at zero, exactly. Now what's in fact turned out is that the banks have gone and instead have basically bought a lot of treasuries. A significant amount of what they've done is instead of lending is actually just go and purchase treasuries. And even on that they've gotten a very big yield between, again, their zero cost of funding, or very close to zero cost of funding, and what they get on the treasury.
So they're getting zero money here.
Right.
They go and buy T-bills.
Exactly.
And they're earning interest in the T-bills. So one arm of public money is financing them to earn money from another arm.
Exactly. So
good business, but you need a lot of money to get into that business.
You need a lot of money to get into that business, exactly. And the whole point is that the banks have a lot of losses they haven't yet recognized in the crisis. So this is a way to basically, without having any bills go through Congress that would be very unpopular, to recapitalize the biggest banks, which are the weakest. Now, then the Fed has another set of stories that it tells, and I honestly think that Bernanke actually believes his PR. He has stories like this in various papers, but he said it in a more straightforward fashion in an op-ed in the Washington Post the day after the $600 billion so-called quantitative easing program was announced. First thing he said, this program has worked so far, which is absolutely untrue. The Fed did a first round of quantitative easing, and obviously we're still at 10%. Okay,
for everybody that hasn't heard this yet, quantitative easing, if I understand it correctly, has increased the money supply, except they don't want to say that, and they keep coming up with these cockamamie.
It's specifically that they go out and do it by buying treasury bonds, and they do it, the argument is that they are doing it to lower yields, not just on short-term money, but to lower it on 10-year money, 30-year money that the Treasury borrows out. So the idea is the theory is that if we lower rates on the lowest risk assets, which are Treasury bonds, therefore it will lower rates on all the other assets like mortgage bonds, and it will make equities more attractive purchase. Basically, to put it another way, the notion is that by making treasuries so unattractive to own, by making the interest you can earn on them so low, that investors will have to go out and buy riskier assets.
In other words, get back in the stock market.
To get back in the stock market,
so
to get back in the real estate
stock market bubble.
Exactly.
To supposedly get the economy
And
going.
that's the whole problem with this logic, is the first time any central bank went on this program was Japan in the bubble era. Japan had a problem then that they had a very big export sector and very little in the way of domestic consumption. And they were getting a lot of pressure, particularly from the US, because it was such a mercantilist policy and it was taking so many jobs from a lot of other countries, but particularly the US, and Japan is de facto a military protectorate. So we do have a little leverage over Japan, unlike the situation we have now with China. But so the Japanese went to engage in a similar program of very low interest rates to try to stimulate consumption. And the notion was, we're going to pump up asset prices, we're going to pump up real estate and stock market prices, and everybody will feel richer and they'll spend more. Well, of course, all that they got out of that was the bubble and a 20-year bust. So this program has no history of success.
And a lot of furious retired people.
Yes.
Which is a lot of what drove this election last Tuesday. Is anyone that hopes to live on interest income is furious right now.
Exactly.
More than furious, they're getting poor.
Exactly. So we had the first part, which is it didn't work in Japan. Then we tried it when the economy was weak. It was a different fact set than in Japan. Gee, let's try it when the economy is weak. QE1, there was one study done by a California academic who said that, Jim Hamilton, who said that for
QE1, quantitative easing 1.
Right.
Not the vote.
Not the vote. Yes, exactly. QE1, quantitative easing 1. because the Fed had an earlier program where they bought something like $300 billion worth of Treasury bonds and nearly slightly over $1 billion of mortgage-backed securities. And he found that they only lowered long-term interest rates by 17 basis points, 0.7 of so that's 0.17, 0.17%. So for all the money they spent, it had only a very small impact on interest rates and obviously no impact on the economy. It was Einstein who defined insanity as repeating the same behavior and expecting different results.
Okay, I'm a great believer that Bernanke and anyone that succeeded on Wall Street is not insane. So if the objective they're claiming it is ain't going to work, it means there is an objective that is going to work. So let's back up a second. A whack of cash is now being put back into the hands of the big banks. They're still making the spread on T-bills, and now they're selling off the T-bills. Why? Isn't one of the reasons is they're taking the cash now and they're going to Brazil and they're going to other places where they can earn even bigger spreads on their 0% money?
That's correct. That's the big concern, is that there's a big pushback in a lot of the other other banks and policymakers in other countries, because they say all this is going to do is stimulate inflation. That we're going to have a resumption, another finance term, of what is called the carry trade, which happened in Japan. When after Japan's bubble era, they had a protracted period of very low interest rates. And what other investors would do is they would borrow in yen because the borrowing rate was very low, and then they would go buy assets in other currencies. And that and when you do that, you actually wind up selling the yen, because if you're going to, again, if you borrow in yen and you're going to, say, invest in the New Zealand stock market, you have to sell your yen to buy New Zealand dollars. So the act of selling the yen makes the yen go down. So the low interest rates and then the falling currency go together in this sort of carry trade. And the big risk is that, gee, something's going to change and the yen goes up relative to the New Zealand dollar. You lose more on the currency than you saved on the interest rate. There is a risk in that trade.
So let me ask you a question. Is the reality of what's happening here, forget all the rhetoric coming from the Fed and other places, it wasn't that we were a year and a half, 2 years ago, looking into the abyss. The finance system and the global economy was hanging on by fingernails, dangling. And what they've been able to do now is cover up the fact that we're kind of still hanging. The finance system is still dangling because there's so much bad, toxic stuff that's being hidden on the balance sheets of the big banks. So what the Fed's really trying to do is bail out the big banks before this all explodes again, and everybody finds out the financial system has no clothes.
Right, that's correct. But I honestly actually think that the Fed does believe to a degree this story they tell about quantitative easing, which I find, that it will somehow stimulate the economy.
But how? Because the banks are already sitting on $1 trillion
well,
they won't loan.
Well, they believe
now they'll have $2 trillion to sit on.
I have to say that I think they believe it for different reasons. That everybody they talk to is in Washington and in New York, and those two economies are doing relatively well, so that they are getting feedback. They don't go out in the real economy. They're getting too much feedback from the wrong people.
Or is it just about how do we create another bubble and the hell with what's going on Main Street?
Well, it could very well be that also. But the second thing is, when you were talking about sort of the hanging on, the image that I use is what happened is we had the equivalent of a 500-pound man, which is our bloated financial sector, that's already diabetic, that then had a heart attack and went to an intensive care. And normally what you would take with the 500-pound diabetic man who had a heart attack is give him the quadruple bypass, get him to lose weight, and as soon as he'd lost enough weight that he could exercise, go out and exercise. What we've instead done is put him in the hospital, he's getting meds, and he's ordering in from his gourmet restaurant, and his friends are bringing him bonbons when they visit, and so now he's actually gained 50 pounds.
So he's getting burgers and cherry pie intravenously.
Right, that's correct. So, we haven't solved anything, and if anything, the problem has gotten worse because the big banks, were too big to fail, actually got more concentrated because players like, Bear Stearns were merged into the big banks, so the big banks got bigger. So
as part of this, that if they don't hide just how fragile and weak the banking system really still is, the market's going to crash. There's no chance of getting their bubble going,
right,
and back to Panic City.
Right, exactly. And the other thing that the regulators are doing, and the Fed is included, is something they call, again to use another technical term, regulatory forbearance. The banks are still carrying a lot of bad assets. For example, they're carrying a lot of second mortgages. And with housing down 25 to 45%, if you foreclose on a house, all that money is going to go to a first mortgage. There's going to be nothing left for the second mortgages. They really should be written down quite a lot. And yet the banks, the four biggest banks, which are the ones that are most at risk, are still carrying them on their books at values of hundreds of billions of dollars. Just writing down the second mortgages alone would show these banks to be very weak. But they're not being required to do that.
So if you understand this dynamic, I'm saying, and I'm sure people on both sides of the Fed and Goldman's and all if you're on the inside of Wall Street, you know all of this.
Right.
So what you're doing is creating the bubble because you know when to get out.
Exactly.
You'll get out, the bubble will burst, and there'll be another whack of people losing their pension funds and whatever.
Except the funny bit is that they're all telling themselves this. I mean, I even heard some of my investor friends were saying that were basically everybody, at least the investor types, and you presume the Wall Street types are thinking this way also, that the Fed's creating a bubble, we're going to ride the bubble, everybody's all in. And the problem is this was the same mentality people had in early 2007. You could tell it was going to end badly. And everybody thought that, oh, we'll just ride it and we'll be able to get out on time, we'll be able to save our hide. Even the professionals couldn't. That's why we had a crisis. That what happens in a crisis is suddenly the number of trades and the volume of trades you can do collapses. And they can't exit. They think they can exit in time, and the reality is the exit shrinks.
What do they
and
care?
Only very few people get through.
They're going to get their bonuses. And too big to fail is still too big to fail.
Right.
So it doesn't matter what the finance reform legislation was. We know it didn't solve too big to fail, and they'll come back again.
Yeah.
So why not? What's to lose? Except the rest of the society has a lot to lose.
Well, the one thing that might happen this time, if we have a crash sooner rather than later, is people are already profoundly angry with the banks. And if we have a crisis of some type in, I would say, the next 6 to 18 months, there's going to have to be a pound of flesh for another round of bailouts. It's not going to be acceptable for there to be another round of bailouts without at least the management of major firms being fired. I mean, there will have to be some price to pay.
And they will rip the Republican Party apart, because how did the Tea Party sign on to another bailout? And we know old line Republicans will be there. I mean, Bush always was.
Right, right.
Okay, segment 2, we'll come back, and we're going to talk about what should be done, because the way it's going don't look good.
Right.
Thanks for joining us on the Real News Network, and come back for part 2.